And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Tuesday and got a lot of things going on the website today. We'll get into a new blog post out this morning talking about forecast for 2024, right? So everybody's now doing their year-end predictions for 2024. So we'll talk about some of those this morning. But again, fairly light week so far in terms of economic data. Factory orders came in a good bit weaker yesterday, still showing kind of some disappointment in the economy. So if you take a look at the Economic Surprise Index, that's an index that tracks whether or not economists were surprised to the upside or the downside when the data comes out. So that index has been declining, suggesting that the data has been coming in a lot weaker than economic estimates so far. So again, there's a lot of sentiment about next year, that the economy is going to be very strong, et cetera. But we're starting to see some weaker economic data come in. Now, this is coming off the heels of quarter three, which had that 5.2% growth rate in the economy. Quarter four not shaping up to be nearly that strong. Right now, according to the Atlanta Fed, that's running around 1.2% growth. So we're starting to certainly see that beginning of that slowdown in the economic activity. And again, not surprising here, but there's been so much stimulus and so much money in the markets that's kept economic activity elevated. People had a lot of money in savings. That's beginning to run out. Very interesting article out this morning talking about these buy now, pay later schemes, which are these companies that you can go to. You can borrow money. You make payments over 4, 6, or 12 months, and there's generally no interest on them until you don't make your payment. And then things get pretty nasty pretty quickly. Seen a huge surge in the use of those buy now, pay later schemes here over the last couple of months. In particular, people starting to shop for the holidays, et cetera, looking for other sources of income. So, basically what that's saying is they've kind of tapped out the credit cards. And as we talked about before, consumers are always very creative about taking on additional leverage, finding some additional money here or there. Well, they're running out of credit cards, and so now they're turning to these buy now, pay later schemes in order to fund that buying as we go forward. So again, this is why economic data always, it's like, man, how do people keep coming up with the money? They find it, and consumers are very creative, not to their best interest, of course, but they're very creative about finding money. But that's keeping some of this economic data, at least at the surface, more elevated than probably it should be. And here's the interesting thing right now, if you take a look at gross domestic product, that's been doing very well, right? Gross domestic income, which is the income generated, has not. In fact, we have a record divergence right now between GDI and GDP, suggesting that underneath the surface, the economy is not nearly as strong as what the economic data says. So either gross domestic income is going to have a rapid catch-up to GDP, which is not usually the case, or GDP is going to catch down to GDI at some point. So next year we see weaker economic growth. Now that's right in line with what kind of the Federal Reserve wants. They want weaker economic growth. They would like unemployment to come up a bit. But the problem with weaker economic growth is, well, estimates for $220 a share in earnings next year is going to be really hard to get to. Right? Weaker economic growth suggests that there's weaker buying. If there's weaker activity in the economy, that means less revenues. If there's less revenues, that means lower profits for these companies. So again, that's going to be kind of thing. Now, today we've got the ISM non-manufacturing index coming out this morning. That, as we talked a little bit about yesterday, that's 80% of the economy. So what we take a look at in terms of those services indexes, that's been an expansion, and not by much, right? But it's been an expansionary territory. Are we starting to see some weakness on the service side of the sector? That's going to be one of the interesting things today to pay attention to. That should also, if that number comes in weaker than expected, that could potentially weigh a bit on the kind of the outlook for higher inflation or higher Fed, potentially the Fed hiking rates, et cetera, because that's going to feed right into the rest of the economy. Those services are very important now because they make up such a big chunk of the economy overall versus manufacturing. So, all right, having said all that, here's what you need to know before the bell this morning. Markets did sell off just a little bit yesterday. We were down about 30, 40 bips yesterday at the close. Came off the lows, though. Despite the fact that the markets ended down for the day, there was a couple of bouts of buying during the day. So as the market would kind of sell off in the morning, in the afternoon, we had the markets kind of rally back a bit, then they kind of sold off a little bit, and then into the close there was buying. And what that's showing is that there's still people buying into the dips of this market. So as the market tries to sell off here a bit, you kind of keep having these buyers step in. And again, that's not surprising. You know, we've got a lot of this rebalancing going on for mutual funds. One thing that's really been lagging here is the Mag 7, as we've talked about. Apple, Microsoft, Google, Nvidia, those have been under a lot of pressure here over the last couple of days. And that makes sense, right? Don't read too much into it. I'm seeing a lot of headlines that right now is like, oh, it's now time for the small caps to come roaring back and they're going to take over the lead and all this. Be real careful with that. We're just in 2 weeks of the year where mutual funds are having to look at their portfolios going, well, the Magnificent Seven, which was up like 70% this year, you know, those weights in my portfolio are too overweighted. So I've got to sell those guys and I've got to buy the other stuff in my portfolio that's now underweight because they've been underperforming all year. So that's making it look like right now there's this big rotation in the market. It's probably not. It's probably just a lot of year-end portfolio rebalancing and window dressing going on right now as they're making their distributions. They're having to sell stuff to make those distributions. They have to rebalance the portfolio. So that's all that's going on here. This isn't some big, shift, in the overall market dynamics. Very likely, as soon as we get through this next couple of weeks, we're going to go right back to where we were before because mutual funds, pension funds, hedge funds, etc., tend to chase all the same stocks, and they tend to go with what was working previously. And again, they're buying and they're paying up for revenue and earnings growth, which are in those big companies. So again, don't read too much into this rotation that we're seeing in the markets right now. It's probably going to be fairly short-lived. We'll see. Important thing, though, is that little sell-off yesterday got us very close to a sell signal on our MACD. Now, we're not there yet, but the markets are looking to open down this morning. Markets are about 18 points at the open on the S&P. So if the market ends lower today, we're likely going to trigger that sell signal. And again, that kind of gives us a couple of targets to go to on some type of short-term correction that we've been talking about here. 44.80 is the 20-day moving average right now. So again, that's not too far below where we are right now. We closed yesterday at 45.60. So a pull down to 44.80. Below that is 43.50. So again, a little bit bigger correction there. You get back down to 43.50-ish. That's the 50-day moving average. Good level of support right there. And probably that's where the market's going to hold at this point going into the end of the year. And again, as we talked about before, we're just set up here. Our money flow indicator has already triggered an early sell signal. That kind of aligned with this kind of pullback yesterday. And then, of course, if we get this MACD sell signal today, then that is going to suggest, at least in the near term, that markets are going to have more trouble going up versus going down. Now, that doesn't mean the markets are going to crash, so don't overreact to this. But all this suggests is that buying pressure is becoming less and your selling pressure is increasing, and that's going to kind of all coincide with some type of short-term correction here. And again, it doesn't mean anything. But again, if you haven't taken the time right now to do some tax loss selling for the end of the year, to rebalance your portfolio, do it now. This is a really good time. You need to do it before year end anyway. If you need to sell some stuff to do your RMDs, your required minimum distributions, great time to be doing that right now. Take advantage of this rally, sell some stuff here, go ahead and raise the cash that you need for those distributions. But that's what you need to know before the bell this morning. When we'll come back, we'll talk about a range of outcomes for next year. And how we kind of arrive at those estimates. So we'll talk about that right after the break, right here on The Real Investment Show. I'm your host, Lance Roberts. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. So we're going to talk a little bit this morning about kind of Wall Street analyst estimates for next year and kind of a range of outcomes. But before we get to that, I need to kind of give you some background on why analysts are always bullish, right? So when you're listening to the media, when you're listening to Wall Street analysts, et cetera, they're always bullish. And there's a couple of reasons for that. And the first is that it's easier to be bullish than bearish. Why? Because you're going to be right more often than you're wrong. 85% of the time, the market is rising. About 15% of the time, the market's actually declining, right? So you're having a bear market about 15% of the time. You're having a bull market about 85% of the time. And when Brent stops messing around with whatever he's doing and he puts the chart up so you can see it, we can certainly talk about this in more detail. Trying to give you some cues over here. So anyway, so on this chart, this is a long-term chart of the S&P going back to 1900. And you know, the black lines are where the markets are making new highs, right? So if you think about, you'll hear this statement all the time. It's like, well, if you just invested in the markets in 1900, you would have made 8% a year, blah, blah, blah. Well, that's true on average, but markets don't compound. In fact, what you will notice here is that there are very long periods between where markets make highs and where they make the next set of highs. In other words, they spend a lot of time just recovering previous losses. And that's a huge difference than making money when you're just recovering losses. So what's always important about investing is when you start investing, not if you start investing. But it's important, though, that yes, the markets are going up a vast majority of the time, and that's why bullish, analysts are always bullish. It's just easier to say, hey, next year the markets are going to be up because the odds of being wrong are really in your favor, right? I mean, 85% of the time the market's going to be bullish. So if I'm bullish, the market's going to be bullish, and I can say, hey, see, I was right. Markets were up last year. That doesn't necessarily mean anything. It's just that's why that's the case. But it's important to also understand that it's just a really big business for Wall Street. Now, we've talked about this, before, and it's important. But, back in the 60s, 70s, even the early 80s, right? Guys on Wall Street, brokers, we called them stockbrokers back then. They weren't financial advisors. This has been a new marketing twist term. But back in the day, you were a stockbroker, right? And your job every day was to, call a client, sell a stock, and make a commission. And that was actually a much better way of doing things, because you as the buyer, you'd pay a one-time commission to own a stock. You'd sell it for a one-time commission. And that's really a much better deal than the structure we have today where everybody pays a fee, right? And you buy an ETF and you have this fee that you pay every year, which is much more expensive in the long term, but it's great for Wall Street because they annuitized all their businesses, right? We invented mutual funds first. And this was like, oh, look, instead of you just buying all these stocks, buying and selling, you just put them into this fund. We're going to charge you an annual fee and we'll do all the buying and selling for you, right? You just buy and hold. And this was great for Wall Street because all of a sudden they didn't have to sell new stuff every day to make revenue. They had to come in. They actually just had to accumulate assets, tell you to just buy and hold. It was great. And they just collect an annual fee. So now they annuitize a revenue stream. And this has been great business for Wall Street. For the top 24 firms. I went and ran a calculation on the top 24 firms in the investment banking asset management side. It's almost $1 trillion a year in revenue, right? That's just 24 firms out of all the financial firms that are out there. But it's huge business, mutual fund business, pension funds, hedge funds, but anything I can get you to invest in where you just pay an annual fee is great. Right? It's not really that great for you. Commission was way better. Pay $25 to buy something, pay $25 to sell something. But people held these things for an average of 6 years, right? So your actual expense was very low back then. And now you're paying a fee every year to own these ETFs or whatever. And the message from Wall Street is just buy and hold. Why? Because, well, markets go up most of the time. Most of the time. But this is kind of an interesting thing now because, again, it's important as we start looking at the markets themselves. So again, this is, who's the real client here? And we're going to get into this in a second, right? Who's the real client? But have you ever wondered why every stock is rated a buy or a hold, right? Nobody's, there's very few stocks out there ranked to sell. Have you ever wondered why? I went and ran, I went to Zach's research and I pulled down a list of every stock that they cover in their universe, which is over 5,000 stocks. It's 5,170 stocks that they cover in their research. I pulled it down and then I ranked them by which stocks were rated a buy, a sell, or a hold. Right now, this is not Zach's ratings. They have their own rating system for stocks, which is much better. But this is the average Wall Street analyst rating on these stocks. Out of 5,170 stocks, 4,335 were rated buy or strong buy. Now, do you mean to tell me that you honestly think that 4,335 stocks out of 5,170 issues, and then you can throw the other hold issues in there as well because that's just a polite way of not saying sell. So 4,800 to 5,170 rated either a buy or a hold. Why is that? Why is that? So why are these ratings that you use to buy or sell stocks like, oh, it's a buy rated stock, I need to buy it. Why are they all rated buys? Well, this is where it comes down to really understanding where you rank in terms of Wall Street, right? And it's also a function of why you need independent advice and analysis that is independent of how Wall Street works. But the Wall Street Journal went and they did a survey, and they surveyed all the Wall Street analysts out there, and they asked them a question. They said, how important are the following to your compensation? In other words, how you get paid. And so your industry knowledge was number one, your standing in the analyst rankings and the broker votes, right? So they all vote for each other who was the best. Your professional integrity, your accessibility and responsiveness, your relationship with management of the companies you follow, your success at generating underwriting business or trading commissions, your written reports, number 8, number 9, the profitability of your stock recommendations was at the bottom of the list. It didn't really matter whether or not their recommendations made were right or wrong, or if their accuracy and timeliness of those forecasts were right or wrong. Those were at the bottom of the list. What was important is how they were ranked among the other brokers and analysts out there. Were they more popular than the other guys? And did they generate any business for the firm? That's what was important. Now, let's go to the next one. So question number 2. Question number 2 was, how important are the following clients to your employer? Number 1 was hedge funds, followed by mutual funds, defined benefit pension plans, insurance firms, endowments and foundations, high net worth individuals, and at the very bottom of the list, retail brokerage clients. Now, when you start taking a look at all these ratings that you're told, you're saying, hey, you just need to buy and hold this ETF. You just need to buy and hold this. You know who doesn't buy and hold? Pension funds, hedge funds, mutual funds, insurance companies, major investors. Warren Buffett doesn't buy and hold. He may hold something for a very long period of time, but he sells stuff. But you're just told to buy and hold this. Why? Because you're the person they're selling all this stuff to. You know, have you ever wondered about an IPO? You know, IPO is like, hey, this company's going IPO, so you want to run out there and buy it. Why? Why would you want to buy an IPO? That's like me having a steak at my restaurant, right? And it's the last steak that's there, and I can sell it to you for any price I want, right? I can sell it to you for a massive premium. And this is the way that IPOs work. The mutual funds, the hedge funds, the defined benefit pension plans, the insurance firms, those are the guys that invested in those companies when they were private. Goldman Sachs was going to bring this company public, and they went around and they did a roadshow with these hedge funds, these mutual funds. Hey, you're going to buy into Uber, right? And then we're going to take it public. And when we go public, you sell all your shares. The insiders of these firms are the ones, and the brokerage firms, right? Goldman and JP Morgan, this is why they do IPOs. It's huge business. It's huge revenue business for them. But who do they sell the shares to? You. They're going, you should buy these shares of this IPO. It's awesome. This is a great company, IPO, right? We're taking it public. And so all the people that bought into it when it was private are selling their shares to you at a huge premium. So you have to understand where you fit on the list. So when you listen to these Wall Street recommendations, you have to understand where you are on this list. Wall Street doesn't care about you. Wall Street needs you. Wall Street needs you to sell product to. That's what Wall Street does. Wall Street is a product generator. They generate products to sell to you. That's why, during 2020, 2021, when we had all that influx of capital, what did we have going on? Massive rush of IPOs. And we couldn't get IPOs out the door fast enough because there was so much demand because all these people had insurance money, government stimulus money. They came up with SPACs, right? It's like, we can get SPACs out faster when we get an IPO, so let's just SPAC these companies out. We don't even know what we're going to invest in. We'll just do a SPAC. People will give us the money. We'll have it, and then we'll just go try to find something to buy. But that was because of the demand. And so again, when there's a demand for product that will generate revenue, Wall Street will feed it to you. It doesn't matter if it's a good product. It just matters that they fill that need for you. Now, understanding that, when we come back from the break, we're going to talk about Wall Street estimates for 2024, where they think the market's going, and we'll kind of review the last couple of years to see how well they did. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that Candid Coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You can get daily real investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Friday was actually December the 1st. The reason I know that, wife's birthday. Can't miss that. So, 39 again. Holding steady, looks great, it's all good.
The Real Investment Show podcast. Same show, your schedule.
With my wife, the birthday goes the entire weekend. It's not just Friday, it's Saturday and Sunday. It was a lot of servitude over the weekend.
At realinvestmentadvice.com.
Kind of glad it's Monday and she had to go back to work.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now, with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, understanding now, as we talked about last segment, that Wall Street's not really in this game for your benefit. And it's always interesting. I love the slogans of these big Wall Street firms like UBS. It's you and us. It's them and them. It has nothing to do with you. They just want to sell you stuff. So just kind of keep this in mind. But this is why analysts are always bullish, right? Because if I came out and said, hey, you know what, next year, market's going to be down 20%. That's, your first response is, okay, well, if you're saying the market's going to be down next year, I'll just go to cash and I'll just wait it out, right? Problem with that is they don't make any money. They can't sell you anything by being bearish. That's why they're always bullish. And this is because bullish sells product. And that's all this is. And the reason that you want to be bullish is because I can sell you stuff. So if we go back to 2021 as an example, in December of 2021, Goldman Sachs came out and said that the S&P would climb 9% to 5,100 in 22. 2022 turned out to be a year where the market was down over 18% after including dividends. So clearly a big gap between what Goldman said was going to happen and what actually happened. But that's okay, right? So they obviously got it right the following year because, 2023 was a good year, right? I mean, we're almost at 5, we're at 4,800-ish here just recently. So, I mean, obviously 2023, they certainly nailed that one, right? So, if we take a look at the Wall Street targets for 2023, this was a list of the 10 companies on the 19th of December of 2022. Barclays Bank was estimating 3675. Where was Goldman? Goldman said 4,000 on the index for 2023. Problem with that is, of course, is that what they assumed and what actually occurred, two very different things. So, these forward analysts, these forward estimates are, very wrong. And, the problem is that, had you been investing based on these forward estimates, well, it didn't really work out that well for you. So what is saying about 2023? Well, here's the latest so far. This is now these are going to change, right? This is early, so we're gonna get some more out here towards the end of the year, and the closer we get to, the market high for the year, these all get ratcheted up for next year. But Deutsche Bank at 5,100, Goldman's at 4,700. Goldman's saying, hey, you know what? We're gonna be lower next year than we are right now, right? So, will they finally be right? I mean, eventually they're going to be right? Well, they're hardly ever right on these estimates. And again, this is generally the case with things, and certainly something to consider. So here's the important thing. Throw all this stuff out the window. It's not important, right? We go through this annual ritual of everybody kind of, our 2024 outlook is the economy's going to do this and the market's going to do this. Nobody knows. What we do know and what we can work with is that we can work with valuations, and we can make some assumptions on valuations based on the things that we think could happen, and then we can develop a range of outcomes that we can invest with. And that's kind of the exercise in today's article. So if you take a look at forward earnings estimates right now for the S&P, they were at $227 a share. That was the initial estimate for 2024. Those have already fallen to $220 a share. So already down $7 on forward estimates, but we'll use the 220. Now, just understand that between now and this time next year, when we get to the end of 2024, that number will be lower. But let's just use 220 as a basis for our exercise today, and let's do some valuation modeling based on some different things. So the first thing is let's assume no recession next year. And we assume that, well, if there's no recession next year, we could probably maintain the same valuations this year, at 22 times earnings. And at 22 times earnings, based on $220 a share, that gives us a target of $48.45 for the market next year. Now, we're already at basically 4,600-ish, right? From 45, 4,600. So it's not that much of an upside to maintain 22 times earnings. And again, that's assuming that we stay at $220 a share. At 22 times earnings versus a lower, earnings per share growth. So if we get down to 210, right, 200, it's going to change this number. But we have a range, right? We have an upper end of our range now of a market with no recession at 22 times earnings. Now you can pick other valuation measures. Just, again, this is just a mental exercise for you to go through, and you can do this at home yourself. Just pick some ranges and say, okay, if we do $220 a share, and I think valuations will be this next year, they'll give you a target. But let's assume that we have a soft landing recession, right? So this has been one of the theoretical outcomes for next year, is that higher interest rates, lower economic growth, we kind of get this mildish recession. It's not a financial crisis type recession. It's just a normal run-of-the-mill recession. Valuations in theory should fall to about 17 times earnings. That's not a big drop from where we are currently. We're at 18 now, so you go to 17. At $220 a share at 17 times earnings, that gives you a target of $37.44. So obviously some downside risk. That's about 17% decline next year. So there's certainly a setup here for a recessionary outcome of the markets. And if we take a look at normal recession links and take a look at recessions historically and the average drawdown, 17% is well within the context of a recessionary drawdown over time. So, again, the average recessionary drawdown is 33%. So 17% just, is kind of a mildish, soft landing-ish recession. It's not terrible. Nothing falls out of bed. So certainly within the realm of normality. But let's assume that we have a year like this year. We also need a bullish scenario, right? We need a scenario that we have a multiple expansion. So in other words, we have $220 a share, but people are willing to pay up for that. And so in that environment, we're looking at a very different outcome, which is an environment where we have valuations expand to over 24 times earnings. Now that'd be up from 24 times earnings, where we are currently, but that's that multiple expansion. And that's very similar to what we've had this year. So 2023 was a year where the vast majority of the gains this year came from multiple expansion rather than earnings growth. So this is a good viable target. Now, if you have 24 times earnings of $220 a share, that gives you a target of $53.95. So base call it $5,400 next year. So now we have a range of outcomes. So we've got a recession outcome, we've got a kind of a normalcy outcome, and then we've got this really bullish kind of outcome. And so if we put those onto a chart, we can kind of develop a range of outcomes for next year that run the gamut from a decline back to testing kind of those October-ish lows or retest of those lows. And that's certainly well within the realm of reality of how markets work. So, again, kind of this retest of previous lows would not be surprising at all in a mild recession type outcome. If you have just kind of a no recession kind of normalcy outcome, and by the way, we did this analysis last year, and the target last year was 4,650, exactly where we're trading now on this kind of normal outcome. So again, the market's exactly where this exercise that we did last year predicted the markets would be this year. So again, on that kind of a normalcy, no recession outcome, you're talking, basically kind of, just barely testing new highs for the markets. And then of course you have your more bullish optimistic outcome at 220 times 24 times earnings, getting us close to 5,000. So that's a range of outcomes, and that's a pretty broad range. Now, what you'll notice though is that the upside is much less than the downside. Your risk reward basis next year is not great. And that's because of the economic environment and because of assumptions. And again, now this is all nobody knows what's going to happen next year. I don't know. Nobody knows. And this is why when we talk about this, making assumptions and forward, kind of forward forecasts, those type of things, nobody knows what next year is going to hold. But by developing a range of outcomes, we at least have some probabilities and possibilities that we can work within in terms of managing portfolios and establishing some guidance of where things are going to be. Now, there's a chunk of you out there right now going, I think the market's going down 17%, and that's okay. Right? And then there's a chunk of you out there that are going, I think the markets are, going to 5,400. And then there's another chunk of you that says, it's probably where we are right now. We'll just have a flat year next year. Yeah, those are all possible outcomes. The problem is don't get wed to any one of them. No, we don't know where they're going to be next year. We have a range of outcomes, so we know what our risk and our reward is. Right? And so we can manage portfolios for that range of risk and rewards, but we have no idea how next year is going to turn out. All right. Quick break. We'll come back. Get ready to wrap up the show. You listen to the Real Investment Show right here. That article on the website right now, if you want to go look at all the charts and the graphs, the analysis, it's on the website, realinvestmentadvice.com. If you're subscribed to our newsletter, you'll get this by email as well today. So if you haven't subscribed to our newsletter, do that at the website, our daily market commentary. And be sure, if you're watching the show, please like and subscribe to the show. We appreciate it very much. We'll be right back after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
You know, there's a few things in life where you go, no duh. One of those is there's a trend running on TikTok right now where people are going, talking about the cost of food and things like, hey, I went to Target the other day as an example and had a basket full of stuff that was going to cost me $345. So I went to self-checkout and it was $38.70. And, this is a problem that's arising for, retailers and grocers in particular, is this whole self-checkout deal. Because theft is on the rise. Theft has doubled for groceries. Now, look, first of all, we don't have a lot of really good data on store theft because it's very closely guarded data. They don't want it to get out because they're afraid that if it gets out, that it'll spur more theft, right? If people really knew how much theft occurs at a store, then it would spur more people. It's like, oh, everybody else is doing it, I'll do it too, right? But they did a survey of Gen Zers, and they found out that roughly 33%, 1 in 3 young shoppers has admitted to giving themselves 5-finger discounts at self-checkout counters. And this is according to a new survey from Lending Tree. And it's not surprising. It's kind of like, one for me, one for you, one for me, one for you, two for me, one for you. And again, look, high prices of food, inflation, right? Yeah, I get it, right? I don't condone it, right? I'm not condoning that, people are doing this, but I get it, right? You've only got so much money to spend and you've got to buy groceries for your family. Then, it gets tempting to, just kind of sort of swipe the bag of kitty litter and it doesn't quite ring up, right? And just kind of goes in your bag, or you just kind of forget to, ring up the bottle, the 24-pack of water, at the bottom of the grocery cart. Those things happen, right? It's totally accidental, just happens. Maybe. But so right now these grocers are trying to figure out, what to do with these kiosks, right? So and this is the problem though. And this is the problem with theft. Theft actually creates more inflation. Because if I have theft occurring at my store, my theft increases, I've got to raise the prices on my other products and goods and products and goods that I'm selling to offset my losses. So the more that people steal, the more that people have to raise prices on other stuff to compensate for those losses. Now, some of those losses just get written off on taxes, those type of things. There's loss provisions and accounting statements, et cetera. But, ultimately it's becoming more and more problematic. And of course, laws are certainly, the political climate that we have currently, and, states like, Illinois that are basically decriminalizing things like theft and, petty theft, robberies, those type of things, are decriminalizing that activity. Is certainly encouraging this, right? If there's no penalty for stealing, then why not? Why don't we just have a big free-for-all and everybody just goes to the store and takes what they want? If there's no criminal penalty for stealing, then why shouldn't I? So it certainly doesn't, the political climate, the legal climate certainly doesn't deter young people from taking some five-finger discounts at the grocery store, trying to save a little bit of money, especially in this environment where things are tight. As we talked about, the first segment of the show, that, the use of these buy now, pay later schemes are rising dramatically right now. Why? Because people are running out of credit cards. They've maxed out their credit card. They have no savings left in the bank account. And so now they're having to do other means of raising capital to make ends meet. Although some respondents, I'm just reaching you from this. Although some respondents to the poll said they regretted having sticky fingers, 44% plan to continue stealing from self-checkout kiosks, while 37% said they would do so to save money on groceries or healthcare goods, according to surveys. Of those who had stolen at kiosks, only a third said they had ever been caught, according to the data. Retailers, as I said, are generally reluctant to release the data. So we'll see what happens. These self-checkout kiosks were a great boon to stores like Walmart and Target and Kroger's, et cetera. Go to the store, check out your own groceries, because they could get rid of the humans, right? We didn't need human checkout people, which reduced labor cost. But now some of these stores are going, it's not worth it. Right? I'll just get rid of the kiosk and I'll just add one more person back. And now when you go to shop, your checkout line is going to be an hour long. Right? They're not going to add, when you go into, it's always interesting. You go into like a Kroger and there's like 15 or 20 checkout lines and there's like one of them that's open. That's not going to change. You're not going to go back. It's not going to go back to the days when you walked in and all 15 checkout lines were open. And you could just move people through, check everybody out. Those days are over. The question will be whether or not they can figure out a way to make these self-checkout lines, more secure, which I don't get. It seems pretty easy. You just put an RFID device on all of your products, and so you just walk by a scanner, and it scans the RFIDs, and it just checks everything out, right? But who knows? Somebody will come up with a solution, or the self-checkout thing will go away, and your shopping is going to get a lot longer at the grocery store. Walmart removed self-checkout stations at some of its stores in New Mexico earlier this year after employees reported a rise in self-checkout thefts, Insider reported. Similarly, Wegmans scrapped its scan as you shop self-checkout system last year because of excessive theft. Meanwhile, Costco has said it plans to station more of its employees at self-checkout after acknowledging this year that it had suffered losses in part due to the rollout of the self-checkout scenario. So we'll see how this turns out. But again, it's a sign of the times. Look, if we didn't have as much inflation as we have right now. And this is very interesting, right? Because I get a lot of pushback. We talk about inflation coming down and how the Fed, is fighting inflation. Like, well, the cost of eggs haven't come down, or the cost of milk, whatever. And they're not going to. The cost of groceries are not going down, right? The Fed doesn't want the cost of groceries to go down. They want inflation at 2%. And what people don't understand about inflation is that, yes, inflation's falling, and this is where I get pushback. It's like, hey, inflation's coming down. We should be at the Fed's target next year. It's like, well, the cost of groceries aren't coming down. They're not going to. And the Fed doesn't want them to. But the way we measure inflation is that if a carton of eggs was $8 in January and it's $8 this January, there's no inflation. It doesn't matter that eggs were $6 a dozen in 2021, whatever the number was. The Fed doesn't want inflation to go down. They don't want the cost of eggs to go from 8 to 6. That's deflation, right? That's severe recession. They don't want that. What they want is they want the cost of eggs to go from, $8 up 2% next year. That's what the Fed wants. They want a 2% increase in the cost of goods and services from year to year. They don't want deflation. Deflation is recessionary. Deflation is a problem because deflation is psychological. When prices start coming down, people stop buying stuff going, hey, I think it's going to get cheaper, so I'll wait. Deflation is a very hard thing to fix because that's a psychological thing. So again, this is not what the Fed wants, and so there's this big kind of misassumption that the Fed wants lower prices, and lower prices is not what the Fed wants, and we're not going to have lower prices. You're not going to see a deflationary trend in prices in goods and services. But nonetheless, the impact of modern monetary theory, this whole idea that we could just shove trillions of dollars into the economy and it was all going to be fine, led to a massive spike in inflation that's permanently raised the cost of goods and services. Those aren't going backwards. People will get used to paying for the goods and services, and that number will become sticky. That will become the new baseline. That's why gasoline, when we had negative oil prices, right? Gas didn't go back to the 70 cents a gallon that we paid back in the 70s, right? We're never going to see that again. We're never going to see a quarter for a gallon of gas because prices are sticky. But, this is, so again, I get the 5-finger discounts. I'm not condoning it, but I get it, right? If you're having trouble making ends meet, it's very tempting to skip a couple items while you're self-checking out. But that's not going to get better. So we'll see what happens. But it is interesting. I've wondered how long this self-checkout thing was going to exist because the ease of which to not scan sufficiently all of your items, this kind of trend on TikTok of how to save money by using self-checkout, is a problem for companies. And, we're seeing stores, close, and California is an example, and other areas where, they don't prosecute shoplifting below $950. We're just seeing stores just leave, right? It's creating deserts of retailers in certain areas and certain communities. That's a problem. We just don't have any good solutions for it because we're not willing to prosecute for it. But other than that, it's a different story. Okay, that wraps up the show for the day. Get by the website. The new article is out on the website now, along with our newsletter from this weekend. So check those out. Send us emails if you've got any questions. Always happy to help you. And we'll see you back here tomorrow with Danny Ratliff for the next edition of The Real Investment Show. Have a great day.